Hello, everybody. So SoFi reported earnings, and this is no surprise to followers of SoFi, but it's a triple beat on revenue, beat on EBITDA, and beat on EPS. It seems to be a pattern for SoFi. SoFi has dropped before on triple beats, as I've made multiple videos across the year plus that this channel has been going, but not today. Today, SoFi is up actually close to 22%. And why is it up? Because the market likes GAAP accounting and GAAP EPS, and we have amazing GAAP EPS that was just posted, in the form of 5 cents. And so the market is very, very, very pleased with GAAP metrics. But in my view, I don't cover SoFi for the banking element. Whenever I've covered SoFi, I don't go and talk about the loan book and the loan issuance and the reselling of loans and the capital ratios and the deposits and the tangible net book value and all of that stuff. I typically keep my coverage of SoFi very much at a high level because my channel focuses on adoption in general. And to me, SoFi is an adoption story. It's a consumer adoption story. It's the story of more members deciding to not go with a brick and mortar bank. It's the story of Gen Z. Their first bank, in my view, is not going to be brick and mortar. Their first bank is going to be an app. And what is that app in the US? What is the leading app for that in the US? Well, that is SoFi for the more affluent Gen Z and the more affluent millennial. And I would argue still that it is Cash App for perhaps the more general population. Millennial is how I see it. Younger folks, they do their first paycheck, direct deposit. They're gonna do this on an app, and SoFi is one of the big apps out there, in my view. And so when I look at them acquiring new clients, I see they have plus 8.4% quarter over quarter in new members. They call them members, right? At 7.5 million versus under 7 million in Q3. So that's an annualized member growth rate of plus 38% right now, if I just look at the quarter over quarter number and annualize it. And you can see it's a little bit of deceleration between Q2 and Q3, but if you look at how Q2 to Q3 was compared to Q1 to Q2, you can see you had an acceleration. So you had an acceleration between Q1 and Q2, and now you have a little bit of a deceleration. So I wouldn't read into that. into that. I don't consider this to be a deceleration. It's just growing very, very fast, acquiring these new numbers. That's it. Because SoFi right now they have 7.5 million. Keep in mind that Bank of America and JP Morgan have about 50 million digital banking clients each. And those numbers are on the decline. Those numbers are not going up as the customer base inevitably gets old. For SoFi, it's going up at an amazing number. They are taking market share from the big banks. And, if growth continues that way, they will, in my view, no doubt be a top 10 financial institutions within the next 10 years, which is what they've hinted before on conference calls. And so I love to see this growth very much. That's the type of investor that I am. Invest in growth. If you see about their product and they sell their cross-selling of products, that's happening. The acquisition of new members is turning into acquisitions of products that these members are adopting products, and this is also growing at a 40+% clip. And AWS is picking back up. The AWS of finance, their Galileo, which what many YouTubers, many folks online have deemed the AWS of fintech, which I guess I've reused. That's going back up. That was a big concern throughout 2023 that part of the business was dead. That part of the business is not dead, and of course it could be big, right? It could be a major source of revenue in the future, just like AWS was growing in the background of Amazon. This is a business segment that is growing in the background of SoFi, and future will tell if this was a master move from the CEO to set up this services company. And if you look at lending and financial services products, So not only did I show that these new members are adopting more products, but they're also adopting lending products. So they're borrowing with SoFi, and they're adopting things like checking account and credit cards. These are financial services product. Same. We see tremendous adoption. Maybe the lending will be a little down in 2024 as they've guided, but I mean it's more flat than down. But the adoption of the products continues, and the revenue is up, like I said, and it keeps being up. You see 34% year-over-year growth. So quarterly adjusted net revenue is up, which is great for me. That's what I want. But adjusted EBITDA is up, and adjusted EBITDA, if you follow the channel, is my preferred proxy for cash flow. And I've removed SoFi from a lot of my spreadsheets because I don't think it's a good fit for my spreadsheet, because I so heavily focus on gross profit on my spreadsheet. But adjusted EBITDA in the expanded version of the spreadsheet that I always publish on the channel, adjusted EBITDA as its spot there, and the EBITDA margin as its spot there, and at 30% EBITDA margin, I'm very impressed. I'm very impressed with that type of profit that is made by SoFi. And so let me just move on to the guidance. So the guidance for Q1 is pretty useless to me. It's too short term, so I'm not going to comment on that. But I'm going to comment on what I love about the guidance. So first of all, Galileo revenue, right? The AWS of fintech. The Galileo revenue was guided to be up 50% in 2024. So I'll be curious to listen to the call and see what they see in Galileo, see where that growth is coming from. And then the revenue guide, if you read the statements that have been made, it's between 20 to 25% every year for the next 3 years is what they've guided. And so that is a little lower than my preferred 30%, but it's still it removes so much uncertainty. It is amazing that they guided for 3 years. I'm very happy about that because it removes that uncertainty. And so I don't use gross profit because I've stopped using gross profit for banks. It really doesn't really apply to them. So I can't really tell you how cheap this stock is from my enterprise value over gross profit over revenue growth metric. I can't do that. However, I can calculate a rule of 40 stock for SoFi. And what is rule of 40? Well, rule of 40 comes from the world of SaaS, but it's the addition of revenue growth to actually margins and profit. And you know, on this channel, I use EBITDA margin because I much prefer it over, say, net income margins. So if I still see 30% theoretical returns, another way that I can reach this 30% theoretical return is by adding the revenue growth to the EBITDA margin. And so if I add revenue growth to EBITDA margin, now it's a quite down profitable company. If I add that at 30% return EV, I'm getting SoFi as a rule of 53. So if SoFi is a rule of 53, you know that in my expanded version of the spreadsheet that I've published multiple times on this channel, it ranks really, really well as far as the economic potential of a firm. It ranks very, very well because all I'm looking for is a 30 for any stock that I buy technically. So in conclusion, my investment thesis is getting stronger. And the main reason why it's getting stronger is it's all business as usual for SoFi, but it's getting stronger because of Galileo. Galileo is the main spot for me, which makes me very happy with this stock as it's growing again. Galileo is plus 50%. And this kind of valley of slow growth that Galileo has, I think this is an important lesson that revenue growth in a business segment sometimes can stall a little bit, only to pick back up a year later, right? If you follow Tesla, you know that's exactly where we are in the Tesla growth story. It can stall for a few quarters, and the stock can be depressed when a business segment stalls, but it picks back up. It picks back up eventually. So I'm very happy about Galileo. GAAP profitability means nothing to me. I couldn't care less. All it means is that the stock is now much more expensive, which I guess I don't like because I really enjoyed buying this stock 20% cheaper. But that's all it means. But it's inevitable anyways, right? When a company is profitable, it's going to reach GAAP profitability. It's inevitable, but it doesn't mean anything to me. And I love the long-term guidance for 23%. It's going to grow 23% until 2026. I took the midpoint between 20 and 25, rounding it up to 23%. That's what I'm expecting, 23% revenue growth each year until 2026. That's a bit below my threshold, but the EBITDA margin is so good at 30%, but it more than makes up for the theoretically slightly lower sales growth. And banking is not my passion, so I don't talk a lot about anything that has to do with loans on this channel. I trust a lot of YouTubers out there, and I trust data-driven investing. I've read a lot of his stuff, and I think it's extremely brilliant. And and more importantly, I trust management in general, because you've probably heard me say that after gross profit, I usually trust management to invest that money as they see fit, because management is going to have a better view of a business than me. And who am I to tell management how they should invest that money? They have a fiduciary duty to do well by their shareholders, to do well by their employees, and to do well for themselves, right? Because if they don't do well, they're going to get fired by the board. So I typically tend to put a lot of trust in managers. And I love product adoption. And product adoption is what I can see, and I fully see Gen Z and millennials, they're adopting SoFi, and they won't be stepping foot in branches. Cash is gone. Cash is not part of the Gen Z and millennial experience. And if cash is gone, there is no need for branches. And this is so obvious. And when banks fight that, and when I see new branches being set up in neighborhoods all across America, I look at those new branches in horror, absolute horror, because there is no need. There is no need for them. There is absolutely no need for them. It's just inertia. Right, when you see the competition setting up these brick and mortar businesses, banking is going digital. It's going fully digital. It's not saying brick and mortar. And the last catalyst that I'll say, and this is obviously new. You may remember a few months ago, I made a few videos on SoFi where I was very negative because, I wasn't negative on SoFi as a whole. I always kept my shares, but I was kind of upset with SoFi because they exited crypto, and I realized they were forced. I just want to point that out. I realized they were forced to exit crypto. But I do believe that the Bitcoin ETF, now that we've seen the inflows to the Bitcoin ETF, now that we've seen people selling actual Bitcoin on hard wallets in order to buy Bitcoin ETF because they like to hold it in a wrapper where they don't have to trust their own security. Now that we've seen this adoption, I believe that actually the Bitcoin ETF may alleviate some of my prior concerns because millennials they're gonna want crypto. They're gonna want to have access to crypto. But if SoFi has Bitcoin, that's already a big plus. And I could see this being enough for a lot of more sophisticated investors. And knowing that we may get an Ethereum ETF coming up soon, so that could be even more of an alleviation of his concern. But hopefully, I hope at some point crypto will come back to SoFi as soon as the regulator changes its stance. And to me, it's a story of product adoption. And I'll conclude with this. We're right here to me. We're right in early adopters in SoFi. If SoFi becomes a top 10 institution at some point, we're going to ride all of the adoption of this stock by its customers. And that adoption is what yields to return, and it's what yields to exponential type returns and exponential type growth, which is clearly what SoFi has been going through. Let me show you that chart, for example. It's very, very clear if you see the growth. And if you look at the lending product, you can even see the beginning of that S. You can see the inflection point in the curve. And that's exactly what it is. It's S-curves. It's how it works. It's how it's always worked for my investing style. So anyways, this was not investment advice. This is just entertainment. I hope you were entertained. No financial advice. Please subscribe. Thank you for watching, and have a wonderful day.